Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to episode 69 of Carson's Facts versus Feelings with Ryan and Sonu. This one is brought to us from Y Charts. Sonu, we're titling this one, Can You Take Me Higher?
Oh, boy.
Yeah, let's see where that's going. Which is bringing my next thing I want to bring up here. Something is happening, like as we speak, that has the masses thrilled, masses excited. They've been waiting years for this particular thing that's taking place. Smiles across the board, just excitement. People feel like they're worth more. Do you know what I'm talking about by any chance?
Hey, are you talking about the Kansas City Chiefs and Taylor Swift?
No, absolutely not. No, we can get on that later. No. The band Creed is back together after 10 years, and that's our little play on Can You Take Me Higher? Of course, I'm joking. The market's at all-time highs. That's where I was trying to go with the curveball there. But, yeah, I saw some NFL memes. They showed oh, my goodness. Who's the quarterback for the Ravens? I just went blank. You probably don't know either.
Yeah.
Oh, this is ridiculous.
You're the wrong person.
I don't know. Yeah, well, anyway, they show him. It's going to drive me crazy. But they show him, and they say, this is the last man who can save the universe from Taylor Swift because they need to beat the Chiefs. We'll see. I can't believe I got his face. Look, Lamar Jackson. Sorry, everybody. I'm not going to be all about sports, but that's bugging me. Lamar, save the day. Please end this nightmare. Anyway, all right. So, Sonu, we've got a lot to talk about here. I'll let you. Yeah, I know. We just rant and rave here. So we're going to talk about all-time highs, right? I mean,
all right.
The S&P is there. The Dow already was. We talked about that, but we're going to talk about the S&P, which kind of, I'll be honest, it's not like that many people are excited. We'll get into that, but it's not like people are jumping up and down here. So all-time highs. We're going to talk a little bit about the macro backdrop. We've seen some positives and a few negatives maybe, and some more positive negatives. We'll break down what we're seeing on the macro backdrop, then end things with China. China's stock market is doing extremely poorly, and their overall economy's been weak. And does that matter? Second largest economy, very large. Well, it's not as large a stock market as it was, a couple of years ago, but large-ish stock market. How does that all matter? So, Sonu, let's start with those all-time highs. I want to ask you one first. I've got a bunch of stats and figures, so I'll probably talk for a minute on this one. But it just feels to me like we made all-time highs after 2 years, and nobody cares. I mean, it's really like anybody. People know what you and I do for a living. I haven't heard one person, family, friend, whatever, reach out and say, oh my goodness, stocks are all-time high. How much higher can it go? It's always things people reach out like October 2022.
Mm-hmm.
I mean, every hour some person on the woodwork was coming out, which is fine. That's how it goes. What's your take on that? It just doesn't feel like much excitement.
I have two perspectives on this. One is, I guess, on the market side, and one is, everybody else, folks folks in everyday lives who are not connected to markets, right? On the market side, it feels like, oh yeah, of course. I mean, it feels like, this has been a while coming. I mean, you've talked about like we could have hit all-time highs, last year, right?
Yeah,
I mean, we're just 3 weeks into the year. So, it feels like the Dow was there, the NASDAQ was there. It's just time for the most widely followed index, which is the S&P 500 stocks, the 500 largest stocks in the country. Getting there, about time. Right? But I think with everyone else, it just gets to like, there's still some skepticism. There's still like, I don't trust this. I mean, I don't feel that good. I mean, we'll talk about consumer confidence. One good sign is, stocks have rebounded. People's 401ks have been going up, and people are feeling better, right? I think, especially with gas prices going down, home prices are up. Interest rates may be coming down a little bit. That's helpful. But I think a big underrated factor for consumer confidence is the stock market. And that's, a lot of, I'm not saying everybody owns stocks, but a good number of people do. And especially in the 401ks. And that's positive. But it's like, we're not seeing that euphoria. I remember, I think it was 2020, 2021. Everyone was like, oh my God, Sonu, can you tell me which stocks to buy? I'm not hearing that.
Yeah, 2021 probably with the SPACs and all of the junk stocks that were soaring. You just mentioned like feeling good and things. 2 days ago, I was sitting there just doing something. I took my thumb, and believe me, this was an accident. Took my thumb and I jabbed my eye. I have no idea why. I don't even know if you look real closely on the YouTube channel. I like jabbed the what out of my eye, and even today it still hurts.
Watching an NFL game?
No, not Taylor Swift again. I had to end it all. No, that's actually not true. It actually might have been during that game, but no, I don't know. So like you mentioned, feeling good, and look, right now I want to send out a little positive vibes. My dog Mabel. Talked about her. She's our, I don't know, probably 75-pound Great Dane now. She literally gains a pound a day. She's getting spayed like as we speak, I think. And they do this thing with big dogs where, of course, we're going to get her fixed so she can't get pregnant. But with the big dogs, the way they're like, think of a Great Dane, right? They're tall and skinny, kind of like look like an AT-AT, right? Remember, of course, you know what I'm talking about from Star Wars. That's for you, Sonu. Which, by the way, your birthday is what? May 5th. May 5th.
May 4th. May 4th.
May 4th. My bad. May 4th. May the 4th be with you. So I don't know what happened on May 5th. But anyway, these dogs' stomachs flip around, these big dogs, and they can tragically pass away. So they said, hey, while we're in there, we can do this. So we're doing this also. We're taking her stomach and literally sewing her stomach to the inside body cavity. So, this is for her own safety down the road, because she acts like we've never fed her every time she eats, and they eat too much and they run and plague. She's still a puppy. So anyway, so Mabel was, I think, literally this second under the knife, so to speak. So good job, or not good job. All good luck, Mabel. Thinking of you, Mabel. So, all right, let's talk a little more about all-time highs here, Sonu. I'll just kind of talk for a minute here. So as of yesterday, which is Monday, we've had 1,186 all-time highs since 1957. Why 1957? That's when the S&P became 500 stocks. That comes out to 7.01% of all days have hit an all-time high. That's an all-time high every 14 trading days. I mean, that's kind of amazing. But here's what I want to bring you in on, Sonu. When I looked into it, and of course, this was the first all-time high since January 2nd, 22, where we had a 25% bear market into October 22, right when we really started getting big with this podcast. Right. We were obviously bullish coming out of it. So that's where we are. We just went the 5th longest time without an all-time high. Again, more than 2 years without one. We had an 8-year streak in the 70s, early 80s, a 7-year streak without all-time highs after the tech bubble, and a 6-year without all-time highs after the great financial crisis. Not shocking. When stocks do poorly, it takes a while to come back. But here's what's amazing, Sonu. And I want to bring you in on this one. 1958 to 68, we saw 281 all-time highs. From 80 to 2000, 20-year period, we saw 513 all-time highs. And since 2013, when we broke out March 31st of 2013, we've seen 384 all-time highs. 96% of all-time highs happened in these 3 clusters. We went years and years and years without all-time highs, and now we're in another cluster. This one, if my math is right, 10, 11 years. We just had a bull market go 20 years making all-time highs. I know we don't know exactly with our crystal ball, but, my take is, there could be years of more all-time highs. It drives people crazy when I say it. I've been saying it for years, honestly, when we broke out in 2013. I said, get ready for all-time highs, maybe for 2 decades, drove people crazy. We're halfway there. What do you think of the idea of these secular bull markets lasting for a while?
Yeah, and everything in between, which is secular bear markets, right?
Yeah.
Like between 2000, I think 2000, 13, you had I think only 2007 saw all-time highs.
A few in 07, and then it was all over. And
it was all done. And what's interesting is people probably quote that and say, oh, this could be 2007, without thinking about, oh no, we could be at the start of something new. And look, I always like to say this: momentum begets momentum.
Yep.
Because we're good. Once you hit a new high, what's the most likely thing to happen? Stocks have momentum. You're more likely to hit another new high, right? I mean, we're only 2-3 days into this, but Friday of last week was when the S&P 500 hit a high. Today's the 23rd, Tuesday when we're recording this. Monday, it hit a second new high. Right. And then today, I don't know what stocks are going to do. Who knows? But it could hit yet another one, right? As of now, stocks are slightly up. That could be 3 in 3 days, right? 3 new highs suddenly after 2 years of not having any. So there you go. I mean, momentum begets momentum. I think there's always a concern. Oh, it's stocks are at an all-time high. Does that mean things are going to fall off a cliff? No, more often than not, from your work, it looks like, we're probably more likely to go higher than lower.
Well, again, what did Scott Stapp tell us many, many years ago as the singer for Creed? Can you take us higher? We think the market can absolutely take us higher.
I'm going to have to put my wings here or something.
I know. Which is crazy because, I live near a concert place here in Cincinnati, and there's 15, 16 concerts next summer. The only one that's already sold out, take a wild guess. Yes, it's Creed. So Creed is going to be last summer, it was Taylor Swift to save the economy. This time it's going to be Creed. So anyway, with that, a couple more things to think about. So yes, there's almost 1,200 all-time highs. If you look at the average return a year later after any of those, it's like 7.4% a year later. So a little bit less than normal. Higher 71% of the time a year later. That's right in line. So I think the key thing is don't be scared of new highs, but here's the real good one. When you go more than a year or so without an all-time high, like we just did, we just went 2+ years. 1 year later, again, since 1957, higher 12 out of 13 times, up 12% average year later, even higher on a median. So when you go a while without an all-time high, yes, 2007 was that one time where things just didn't work and spiraled out of control. But again, I think it's just really important for investors to remember that. One more, final one here. So we just obviously had the 10th bear market since 1950, and now we made new highs. So we know that we finally made new highs after the 25.5% bear market. What happens after you finally make new highs? 1 year later, higher 9 out of 10 times, up 10.4% on average was a good deal of the good deal of those times. Higher double digits a year later when you finally make new highs after the bear. Again, 0708 was that one time that things did not work. You can go to carsongroup.com or follow me on X. I've got a blog probably by the time you listen to this podcast. It breaks down a lot of those numbers and figures. But I guess, we'll wrap it up on all-time highs here. I mean, they're bullish. They happen a lot. Yes, one of these days it's going to be the peak in 87, the peak in 2000, the peak in 2007, the peak of 2020. Eventually, you'll have your last all-time high. We just don't think it's there yet. So, any final comments on all-time highs? And we're going to talk a good deal about macro.
I mean, it's been a long 2 years, right? So much has happened. I mean, since the last all-time high, it feels like, I was, sometimes it's nice to take a longer-term perspective about the stuff. Yes, we've had a new all-time high. Mm-hmm. From the data, from the historical data, your work, it shows that you're more likely to continue hitting new all-time highs. Not a certainty, but, probably so, right? But then 2 years ago, the last time we hit an all-time high, the Fed funds rate, interest rates are at 0%, Ryan. Now it's 5.5%. The 10-year yield was at 1.6%, right? So if you lent money to the government for 10 years, you got 1.6%. Now you can get more than 4%. Real 10-year yields on inflation-adjusted bonds is negative. Remember all those piles of negative yielding debt around the world?
I think it was like 18 or 19 trillion at the peak, somewhere around there.
Boom. It's gone, right? Maybe you'll find a few in Japan or something. Now real 10-year yields at 1.8%. The unemployment rate, despite this aggressive Federal Reserve, it's gone from 4.1, it's fallen to 3.7%. Inflation, if you look at a 3-month annualized basis, back in 2022, January, it was running at 10%, Ryan, 10%. Now it's below 2%.
Wow.
Right.
I mean, you just mentioned all these things like stocks at all-time highs, bonds, you're finally getting some yield. Bonds have come back a good deal. By the way, cash, you can make something on cash now. You couldn't do that for the longest time. I mean, there's worries. There's always concerns, but it's just shocking to me when you see so many people just kind of still so dour and so just upset. Really, I think it's upset. I'll be honest. I think a lot of people have missed a lot of this rally for whatever reason. Maybe they don't like who's in the White House. They do this and that, politics, whatever it is. So many people have missed, a good deal of this rally when it comes to equities. And honestly, if you don't own a home, a lot of people have a lot of wealth because of that. We talked ad nauseum about the new highs in all-time wealth and spending and incomes and all wages. All these things have been real positive. Why we said there's likely no recession, and the stock market is a leading indicator. Final comment on this. I mean, yes, again, you can find times this didn't work. I get it. But most of the time, the stock market's leading economic indicator with the cubes, the NASDAQ 100, the NASDAQ, the S&P, the Dow, all making. Now, small caps, no. Maybe we can get into that a little bit later. Small caps, no. We think there'll be a catch-up trade there. But all-time highs are all-time highs. Normally, you do not have a recession a year later, like as astronomically high. You don't have a recession later after an all-time high. Yes, there's a few instances it didn't work, but most of the time, that's a leading indicator. So let's talk about the consumer here. Let's kind of stage 2 of this because it's kind of a neat discussion. I know Michigan consumer confidence just came out. Big jump there. Conference board. I'm not sure what the latest is there. I'm sure you are though. But I know that the big one. Michigan wins a national championship, and all of a sudden they're bullish. Was it that? was it that simple? I guess.
Take it there. You took it there. So I was going to spare you of that. But no, we saw a massive. It's a very widely followed consumer confidence index, right? And that jumped 8 points to close to 79. That's the highest since July of 2021. So 2.5 years ago, that we are back to that level, right?
Mm.
And the 2-month jump, I think you told me, was the largest since 1992. Again,
Yeah,
it
late
goes to
92.
look,
Yeah.
late 92. Gas prices are down, home prices are up, rates are easing, stock prices are up, right? So I think the UFM, Michigan Consumer Confidence Index, is coming more into line with the other big one, which is the Conference Board's measure. They're both now above the COVID lows. I mean, it's look, we don't have GDP data for Q4 yet. We're going to get it in a couple of days by the time the podcast is out. But I think the economy would have grown above trend in 2023. We're looking at 2.7 to 2.9%, somewhere along there. That's much faster than what we saw before the pandemic, right?
Right.
And still, to your point, you just said everyone is dour about, but then you look at what they're doing with their money, everyone's going out and spending, right? That's the other side of the coin.
Right.
And it just had to, so it was like, if you ask people about their personal finance, they're like, oh yeah, I'm in a good place. And in fact, proof's in the pudding because everyone's going out and spending. So we see that in the data. It was just that if you ask them, how do you feel about the economy? They're like, oh, things are, I was going to use a word, but I won't. Things are horrible.
Yes, I mean it's amazing. People drive nice cars and spend a lot on. Oh, the oil's a lot. Yet the car's $80,000, and it's fascinating. Some of the complaining that's going on in the face of all of this. I will say this: you mentioned the consumer. No, not at all. Not at all. Maybe this is part of that. I saw when I was in California last week, meeting with some of our partners, flying around. I had a lot of fun. Hey, Joe. I went and saw The Beekeeper, a movie. I usually don't see movies, but I'm a big fan of over-the-top action movies that make no sense. So here's the deal. I walked to the movie theater because it was like right next to this where we had the event. And I go, hey, listen, I want to see The Beekeeper. He goes, well, it started about 30 minutes ago. I go, you know what? I think I'm okay. I think I'll catch on to whatever I missed those first 30 minutes of Beekeeper. Okay. And sure enough, I did. And it was, remember, I talked about Expendables 4, just so disappointing. I saw Expendables. Oh, my goodness gracious. I saw Expendables 4 is up for like a ton of Razzies, which is like, the worst movies. And rightfully so, I'll be honest. But Beekeeper with Jason Statham was amazing. He doesn't smile once. I mean, he just goes in there and just, does Jason Statham stuff. So if you like movies, it made a lot of money. It's like the top grossing movie this year. Now, I get it. There's not a lot of movies so far this year. So big ups to Jason Statham and the movies. You saw Oppenheimer, which I'm not a fan of. I couldn't figure it out. I'm not smart enough. But you liked Oppenheimer, right?
I did. It took me back to my engineering days. I mean, obviously, I started my master's in aerospace engineering at Purdue and then switched to mechanical, but I was doing mostly the same thing. I mean, I joke that it took me a PhD to figure out I didn't want to do engineering anymore.
Right.
That's how hopefully I'm not that indecisive anymore, but it's good to know what you don't want. But yeah, no, it took me back to a lot of my cohort. They do, they design rocket engines, things like that. Some of them are at Los Alamos. So it took me back to those days. You're talking about like physics and, all the different possibilities. But then, one thing that Oppenheimer brought out was, Einstein says something about God not playing dice with the universe. And, he never could get into quantum theory because he was like, no, things are not probabilistic. Like you have gravity, for example, right? Yep. It's a lot. You drop an apple, it's going to fall, right? If you're on Earth, that is. If you're on the moon, it's a different story, right? But then what Oppenheimer said, no, like if once you get into the quantum world, we won't define it or anything. But once you get really down below, things work probabilistically. And I was thinking like markets too, right? Markets are probabilistic. We're literally talking about that. There's no certainty. So I think there's some nice little analogies that you can draw. I mean, things are not the same. But some of the tools we use, right? Some of the work you do, simulations, looking at the historical data, what's happened in the past. I mean, that's how you try to figure out how do you make sense of a system where there's no certainty.
Yeah,
right.
No, exactly.
There's no one law, right? So I mean that's what you and I'd like to think we do every day.
Yeah, we do our best or try our best to do it. I mean, so many people say, well, you're just looking at the past, looking at the past. And listen, if you've got future data, I'll use it, okay? But past is kind of all we have.
Well said.
Yeah,
well
so all right. So again, a 2 thumbs up for Beekeeper and obviously Oppenheimer. Everyone it's great, man. Let me know what happens the first Let me know what happens the first 30 minutes. I missed the first 30 minutes, but I'm guessing I caught on. Anyway, all right, let's move forward. So yeah, back to the consumer, right? Going to movies, getting out there, spending, doing things. Retail sales came in last week, Sonu, better than expected. But the one I want to focus on, I think, more is the control group came in up 0.8%, 0.8 versus 0.2, 4 times better. Why is the control group, in your opinion, pretty darn important? And just how strong is that consumer?
So retail sales is, just for everyone listening, retail sales, it got retail sales and food services, right?
Yeah.
The only retail sales are good spending, food services, restaurant, bar sales, things like that. It's the only service sector data, consumption related data that we get before we get, the whole massive gamut of consumption indicators at the end of the month, right? Retail sales come out early. But look, retail sales include things like auto sales, gas station sales. That's very volatile. Gas station sales, especially over the last 3 months, annualized pace, because gas prices have been falling, gas station sales have gone down 23%, right? That's
Wow.
right. You take that out, you take all this volatile stuff out, including things like tobacco and things like that. Then you get what you call the control group, right? This is the data, consumption data that goes into GDP. That was, to your point, it was up 0.8% month over month in December, right? From November to December. But, things can be revised. Okay, you take the last 3 months.
Sure.
It's running at 5.3%. Last 6 months, it's running at 5.9%. Last 12 months, 5.6%. All this to say, forget the numbers. There's no real slowing of momentum here. It tells you that nominal spending, like what you and I, we live in a nominal world, right? We're not inflation adjusting. We get paid, we spend that money. Nominal spending, consumption is running at 5%, right? Now you adjust for inflation. If you adjust using CPI, take out shelter, because, obviously if you're spending goods, CPI for shelter shouldn't matter. So take that out.
Yep.
Retail sales are up 2.5% annualized over the last 3 months. That tells you that, okay, that's basically the speed of the economy right now, 2.5%, thereabouts, because it tells, how is spending being financed? People talk about credit card debt, things like that. No, all that is being financed with incomes, right? So it tells you how fast incomes are growing above inflation. It's about 2.5%. And even if you look at the nominal data, we're running about 5% above the pre-pandemic trend. Before the pandemic, 2018, 2019, retail sales after adjusting for inflation is running about 2%. Right now, it's about 2.5%. I think that tells you everything about, how good the consumer is doing in terms of their pocketbooks, and also maybe to an extent how they're feeling about their pocketbooks.
Well, amazing stuff there. Again, the consumer, I think you said, deserved the gold medal last year.
Totally.
We thought the consumer would be strong with the Carson investment research team, but we didn't even expect that strong. And I was just looking at some so I have a presentation coming up, and I sometimes look at old things I save. I got these documents I save for myself, old things. And this shocked me. I actually shared it on X a while back. But in the fall of 2022, we were hearing things like this. Jamie Dimon said, quote unquote, "This is serious. Warns of U.S. likely to tip into recession in 6 to 9 months. Elon Musk, a global recession could last until spring of 2024. Jeff Bezos, batten down the hatches, quote unquote, is the last business titan to warn about a recession. And then we've got Cardi B, who was gloomy about the economy, said, when do you all think they're going to announce a recession? You've got rappers, you've got the most wealthy people in the world, and some of the best businessmen in the world. Back in 2022, it was so universal that we were going into a recession. And honestly, the other part of this was probably the bear market wasn't done. And sure enough, the consumer has just been the all-star. Sono, how is it possible, because the consumers or listeners might want to know this. We did just have the most aggressive Fed we've seen in a generation. We did just have generational inflation, yet you just told me they just keep on spending. How is it possible?
When they started raising rates, right? It's 2022, and this inflation was really high. So the question is, how did the consumer continue to spend during that time? Well, they had at that time they had excess savings, right? A lot of the stuff they didn't spend as much during the pandemic. What they spent on is mostly goods, and then it went to services. They had savings, and then the government had sent checks as well.
Yeah.
And remember, during that time, there was mortgage forbearance. There was, you didn't have to pay student loans, things like that. So we got a break from a lot of things, a lot of little things that all added up to, keep us out of a recession, and the consumer is strong, right? And then you get into 2023, by then inflation is going down, right? Excess savings, I think, was not a big story, to be honest. By then, look, if there's demand, demand feeds on itself. There's a positive feedback loop, right? Then, if there's demand, then businesses are going to invest because they're like, oh, wait a minute, last month was good. Last 6 months are good. Maybe the next 6 months are good. So I'm going to produce more goods to sell it, right? I'm going to invest in all of that. So I think, they hired more people, and, as more hiring happened in the economy, there was more incomes in the economy. And that's what's, kept consumption running pretty strong.
Yeah, no, well said there. Something I was just thinking of. You mentioned 2021. Going back to that time pain for a second. I mean, yes, it was crazy. The stock market was up, but it was these meme stocks and SPACs, and just so much money sloshing around. It felt like a bubble in certain areas. I'm not saying the stock market was a bubble, but certain areas absolutely felt like a bubble. Then 2022 came, and sure, we get it. Supply chain issues, the terrible war, inflation, all these different things happened. But maybe it shouldn't have been such a shock that 2022 just kind of was needed to kind of get rid of some of those excesses that we felt in 2021.
Sure.
And I'll be honest, one warning sign to me, literally on Friday, as the market's making a new all-time high, Dave Portnoy, he's kind of loudmouth guy. Dave Portnoy, Davey day trader, and again, no recommendations here, but he cost so many people so much money in 2021 doing his day trader stuff and just being wrong across the board repeatedly. I mean, this is the guy who literally looked out his window and saw a deer and said, "Oh, I'll buy deer today," right? And it actually worked. It worked, but then it didn't work. Okay, it worked, then it didn't work because everything's going up. So I want to be clear, there are maybe some warning signs. The fact that he's back to being Davey day trader is a worrisome sign, from a potentially from a contrarian point of view. Just something in the back of my head there. But overall, we're still bullish. But that one got me a little bit there. I will say this on Control Group. I did look at this. What's not in there? Auto sales, gas stations, office supplies, mobile home dealers, in case you're going to go buy one of those, and tobacco stores.
Tobacco.
So they don't include tobacco for whatever reason. But overall, anything else in that? One more from me. Our friends at Bespoke mentioned 6 consecutive months now. Retail sales, the headline retail sales, came in better than the expectations. That's an all-time record. They got data back to like 91 or so on this. So again, that just sums it up. People feel one way, the economists are feeling one way, consumers feeling one way, then the data comes in better than expected, a record 6 months in a row. Anything there, Sonu?
No, I think it gets back to that should tell you how fast incomes are growing in the economy, right? And that's always close to 70% of the U.S. economy is run by, is running on consumption, and things are going well there so far. So.
Yeah, good point there. I will say going well. I mean, I walked outside yesterday. It was 46 degrees. It felt like summer because as cold as it's been. Woo, feels pretty good out here. It's cold. I was in Yuma, Arizona last week. Also, it was 76 degrees, literally zero. Most of the Midwest. But yeah, 45 degrees yesterday. How was it, Chicago? Warming up a little bit, I hope.
This morning I was dropping my kids to school and I was like, oh wow, it's like 37 degrees. But what happens when you're going from 0 to 37, you get black ice on the roads. It was crazy wet. So hopefully, the one thing about when it's warmer and by warmer it's relative, right? When it's 37, 40 degrees, it's gray in Chicago. It's like when it's really cold, that's when the sun comes out. So it's like, I don't know which one I want. Do I want sun or do I want to, do I want warmer weather here and gray clouds all over? But hopefully the sun breaks out sometimes this week.
I just want the Ravens to win to just erase Taylor Swift from my TV, but we'll leave it. Sorry, Chiefs fans. I mean, if she wasn't a fan, I probably wouldn't care, but I'm just so sick of the Taylor Swift stuff. All right, anyway, let's do a couple more things on the macro update. Initial claims last week, high level, came in the lowest, second lowest is 1969, so the employment backdrop still looks pretty darn good to me. Housing starts was better than expected. We've seen building permits better than expected as a leading indicator. You've talked about that. I've talked about that. But Sonu, I want to bring the question to you now on industrial production. Industrial production came in better than expected. Manufacturing still solid. I don't know. I mean, does industrial production matter for the future?
Look, manufacturing always matters in the sense, look, it's not a big part of the economy, but these are high-paying jobs, right? And then we saw the disadvantage of, having manufacturing and supply chains stretched across the world. They're not as robust. Something like, hopefully a pandemic doesn't hit again, but you're vulnerable to that, right? Or a ship gets stuck in the Suez Canal and then suddenly prices go up. No, you'd rather have more manufacturing here because, again, at the end of the day, it comes to better paying jobs too, right? And manufacturing know-how is a big skill to have. I think it's good for the economy to have that. That, you talk about the surveys, right? I think that's another big story over the last 2 years, especially for people in markets. They like to follow. Maybe you and I have talked about this. We talked about this with Neil Dutta as well. The PMIs, the Purchasing Manufacturing Index, right? S&P does it. The ISM, Institute of Supply Management, they do it as well. The PMI has been below 50 every month in 2023, or was below 50 every month 2023, which means what? That means manufacturing production was contracting, or so the sentiment surveys told us, right? But you look at the actual hard data where the Fed is actually looking at hundreds of thousands of manufacturers, right? And manufacturing production is actually up close 1 to 1.5% in 2023. I mean, is it fantastic? No. But was it a recession? No. It's okay. Right. A big reason was vehicle production came back. I mean, I think last year this time I was probably excited that, okay, that's going to be a positive story in 2023. Yep. So that happened. And maybe got a bit of a pullback during the UAW strike, but it's bounced back almost immediately. Vehicle assemblies are running just under 11 million, a seasonally adjusted annualized rate. That's more or less where it was pre-strike, and it was more or less where it was before the pandemic, 2017 to 2019. I think we still have some room to grow. So I think there'll be a continued tailwind for manufacturing, right? But two more positive stories within manufacturing, which I think is underrated. One is high-tech production. We talk about AI in our outlook. We talk about, the possibilities of AI, right? And the environment that fosters it, between the Federal Reserve, productivity growth, all of that. But high-tech production, we're talking about communication equipment, computers, semiconductors, all these things that are in that AI space. I'm not saying it's only AI. There's other things too. That was up 18% year over year in 2023. It's up 32% since February 2020. And Ryan, there's no sign of slowing down. By the way, this is real activity. This is actual activity. It's measuring volumes, right? How much of this stuff is being produced? It's not, nominal or anything like that, like when you talk about retail sales, right? Where you have to adjust for inflation. No, this is huge for the economy.
Yeah, and we talked about this before, but they're building all these things, huge jumps in high tech and things like that. We're not even getting the fruits of that labor yet, right? They're building. I mean, that's coming down the line. And one of our big themes we've talked a lot about is higher productivity could be here. We've seen it the last 2 quarters. Well, we've seen jumps in productivity before. It usually just kind of Lucy and the football with Charlie Brown, but we think we're about to see potentially multi-years of a little bit stronger productivity, something we haven't seen since the mid-90s, not the worst time for the economy and the stock market. So that's important to know. One thing you mentioned yesterday on one of the calls we do with our partners, I wrote it down. I thought it was great. The ISM PMI interviews or surveys, probably a better word, surveys 300 managers only. So you got to trust the 300 managers or the hundreds of thousands of managers when you look at the actual hard data. We're not minimizing the PMI surveys, but again, you look at the hard, you look at the hard data, it really is telling a much, much different story. Let me see if there's anything else. One other thing that caught my attention last week, Taiwan Semiconductor, the largest semiconductor company in the world, guided overall better than expected. They see 10% revenue growth, or I'm sorry, they see the overall semi market growing 10% in 2024. They see their revenue growing in the mid to low 20% range, and their stock jumped 10% on that particular day. So again, I don't know, with the largest semiconductor, and by the way, they've got China floating out there. You've got the tariffs, you've got the wars, you've got supply chains, all this stuff floating out there that is very real and very serious. Yet, what corporate America is saying, what corporate America is doing is it should be comforting, I guess, for investors. Anything on Taiwan Semi or anything there, Sonu, before we move forward?
I think it gets to two big macro stories. Literally, the one we were just talking about, factory construction. I think TSMC which is Taiwan Semiconductor. They're building a factory in Arizona, I believe, right now. So that's a big story. I mean, a lot of it is incentivized by the CHIPS Act to reshore manufacturing to U.S. shores, right? So that's a story. And then Taiwan too. I think the Taiwanese stock index. So China, we're going to talk China. China's stock index is sort of mini crash, but it's volatile anyway. Taiwan's stock index is not far from all-time highs. The Nikkei is hitting its highest level since the early 90s. And remember I think it was last week, we were talking about geopolitics, the Taiwan Straits, and China and tensions. Look, if investors are really worried about this stuff, you wouldn't be seeing Taiwan's stock index running up the way it has. You wouldn't be seeing the Nikkei running up as much as it has either. They're all in that same region, right? So again, that's score one on the positive side against the geopolitical concerns.
No, that's great points there. So again, we're going to wind down here fairly soon. Episode 69 of Carson's Facts versus Feelings. Can You Take Me Higher? Brought to us by Y Charts. Let's see, a couple other things I wanted to bring up. We talked about last week, the SEC, the tweet that went out saying that the Bitcoin ETFs were approved. They said, we were half joking. It was an intern that sent it. It turns out it was a SIM swap. So someone literally got that phone number. And believe me, this is above my pay grade, but they did a SIM swap. So it wasn't necessarily an intern messing up, but they literally were, defrauded or whatever you want to call it. I mean, but if they would have done that, the dual, what's it called?
Two-factor authorization. Right?
Yeah, if they would have done that, apparently it wouldn't have happened. So just something to remember there. Anything else happened in your life, Sonu, we want to talk about before we finish things up? Anything fun? What's going on? I mean,
I started watching on that. It's not Jason Statham, but on that similar theme, I'm watching Reacher. Have you seen Reacher on Amazon?
No, I watched the ones. Yeah, I saw the ones with Tom Cruise. I mean, I know it's different, but same character. Yeah.
This guy's more the new Reacher. He's more Jason Statham than Tom Cruise, so I think you'll like him.
he looks pretty serious, at least from the videos. Tom Cruise is Tom Cruise.
The books are great. I really enjoyed the books. So Lee Childs. I mean, it's been fast, quick reads. I mean, it's fun to read. So it's been fun watching that.
Well, I got a lot of stuff in the old queue. Although anymore, I just listen to podcasts. It's funny. I used to read a lot of books. Like my wife and I met 20 years ago. I read a lot, and then kids and stuff get in the way. But I just listen to podcasts. I learned it's just a different way of learning. But there's so many cool podcasts out there as well. That
too many.
Yeah. But, well, I mean, this one. I mean, we'll start with this one. This one's number one. Which, by the way, if you do listen to this one, you can give us a like, give us a follow, give us a review. We'd appreciate it. So, with all of that, Sonu, let's wind things down talking about China. We've already talked about the all-time highs, the macro backdrop. So the Chinese stock market, and we kind of hinted at it here, it's really, really been struggling. Their economy in general has been slowing. Yeah, it's still growing, but nowhere near what it's been growing or what even people thought it would grow this time a year ago. We've still got the geopolitical concerns floating out there with U.S. and China. I mean, you could say, President Biden, President Trump don't see eye to eye on much. Well, they apparently see eye to eye because President Biden's left like every single tariff that President Trump had, and he might even be looking to add a few more. So that's one place that our great country apparently agrees on is being tough on China. I mean, maybe I'll go that route. Is the tariffs that have been put on since, what was it, February 5th, I believe, of 2018. Only reason I know that because that was the first day that Jerome Powell took over in charge of the Fed, and we saw a 4.6% drop on the Dow that day. My joke, and again, it was because of the tariffs, and that's why the Dow dropped that day. And my joke is that's the worst first day anyone's ever had on the job. The guy starts, and it's literally like a 4.6% drop for the Dow, the worst ever first day out of 15 Fed chairpersons. But anyway, with that, how much is that pressuring China, along with all the other stuff you think? The tariffs that the U.S. have had on for a very long time now.
Actually, China, the tariff, I mean, we like to think, I think a lot of people try to think about China's economy in terms of, okay, it's very export driven, and it is a big part of it. But, think about, I'll do this, take the U.S. economy, close to 70% is consumption, right?
Yep.
Then you take a country like Germany or South Korea. Now, those are really export oriented, right? Like 40 to 50% of their economy is exports. Now, China, it's nowhere close to that. What runs, China's economy runs on investment. About 45% of the economy is investment. What does that mean? It capital spending, whether it's by the government or the corporate sector, right? That's
real fast. On. What's the U.S. then? How much of U.S. is based on investment? If they're 40, 45, what ballpark do you know what we are?
Probably close to 15 to 18%, something like that. So it's not much. We're not that reliant on investment spending, right?
Okay.
So China, so coming to 2023, the Chinese economy, after adjusting for inflation, grew just over 5%, 5.2%. Now, that's better than 3% in 2023. And you're thinking to yourself, 5% is pretty good. But look, this was supposed to be the year of reopening, China emerging out of COVID, right? And we still got 5% growth. By the way, before the pandemic in 2019, China was the real GDP growth was about 6%, right? So big picture, actually, rewind all the way back to the 2000s, right? In the 2000s, it was running. Chinese economic growth was running about 8%. That's when we thought, China is going to be the biggest economy within 40 years, things like that, right? Then in 2012 to 2015, it slowed to about 7%. 2016 to 2019, it slowed to about 6%. Now we're probably looking at 4 to 5%. And look, that's going to be meaningful for global growth, right? Even demand for commodities, and even, to be honest, earnings for multinational companies in the U.S. that have significant exposure to China, whether it's your Apples of the world, Teslas, things like that, right? But
Kentucky Fried Chicken, I heard, is very big over there.
There you go.
So Yum brands, maybe.
Yeah. No, absolutely, right? So going to investment, right? I won't spend too much time on this. But look, 45% of China's economy is made of investment spending. I talked about in the mid-2000s when they were going gangbusters, right? Investment spending was running about 25% year over year. And that's how China recovered from the financial crisis. Actually, China came out of the financial crisis looking really good. Then 2012, 2013, investment spending slowed to only 18-20%. Then by 2019, that eased even more, right? Remember, how is investment financed? It was financed with debt. And debt became a problem in China. We talk about, what about US debt? In China, debt is about 286% of GDP, total debt, households, corporate sector, and the government. The government debt is actually not large. Corporate sector debt is a lot. And that's how they finance investments, right?
Hey, let's just real quickly, let's just make sure. I mean, that's way different than the United States, right? The United States has a lot of government debt. And there's corporate debt. We're not ignoring there is corporate debt, but we've got a lot more government debt, which, listen, I don't want to go down that rabbit hole, but maybe when you've got the world's reserve currency, maybe when your economy is growing, government debt just simply doesn't matter as much. When you have too much corporate debt, and then something starts to wiggle and you get knocked off that platform, that's where some trouble can come, right? Is it that simple?
It really is. I mean, a lot of that debt was taken by developers, real estate, right? Most of the investments, you're talking about investment spending that runs the Chinese economy. Most of that investment is actually property investment. Property investment crashed in 2023. It was down 10%. So because that overall investment spending ran, remember, it slowed from 25% to 20% in the mid-2010s. Then by 2019, it was running about 6%. Last year was just about 3%. That's because of a 10% crash in property investment. And it gets to look, if a developer is highly levered, what happens? I mean, if things are good, you're selling more homes, you can ride with it, right? And we got a taste of that in 2007, 2008, 2009. But then suddenly if people stop buying homes, there's no revenue. And then you're toast if you're leveraged up to your hilt. Right. And that's literally what's happening in the Chinese property sector right now. And the government's aware of, there's a lot of bad debt. I think this is going to continue. If you have to ask, okay, will China's economy reaccelerate? The real question is, will investment spending reaccelerate? And then will property investments reaccelerate? And there, I think the clear answer is no. And I think that's why China's economy is slowing. Look, this has an impact on, I think, commodity demand. Going back to here, three last numbers I'll give you, Ryan. March of 2021, China was building residential property at a rate of 1.7 billion square meters per year. I mean, just forget what exactly it means. It's a lot of, real estate property, residential investment. By December 2022, that was March of 2021. A year and a half later, December 2022, that got cut in half to about 880 million square meters. By October of last year, so 1 year later, it got cut at another 20% to about 700 million square meters. So you gone from 1.7 billion square meters per year in terms of construction to under 700 million square meters. Think of all the construction materials, copper, things like that, how much less of that you're going to need if this massive economy, the second largest economy in the world, is slowing down.
Well, that was interesting. So let's make this full circle then. So if the Chinese economy is not as strong as it was, the U.S. economy seems to be doing just fine. Are we not as impacted? Is Europe potentially more impacted by a slowdown in China than the United States? I mean, how does it all kind of come full circle for the listeners and investors on this podcast?
Short answer, yes, right? We think about the U.S. as a global economy, but the U.S. is actually fairly, I don't want to say insulated, but sort of, right? Because a lot of it depends on consumer spending, our own consumer spending, like you and me and everyone else, right? Whereas Europe is actually dependent on exports. And now a lot of the exports go to, come to the United States, but a lot of the exports go to China as well, right? You think about luxury retailers, things like that. So if the Chinese economy is slowing, to your point, short answer is yes, it impacts Europe more. It obviously impacts Asia, I think.
As we released our outlook a few weeks ago, we talked about it a lot, and we've talked a lot before. We like the United States from an investments point of view the most. We'd say developed international second, led by Japan, and we've had EM third for a while. Now, if you took out China, maybe there's some pockets of emerging markets that are stronger, but China is such a big part of emerging markets. That's why we still would say be underweight emerging markets here. Anything else on kind of how do you construct a portfolio from a global point of view, Sonu? Then we probably need to wind things down here.
Yeah, if you think about a global equity portfolio, I think, look, this will probably come out of our outlook. I mean, if you read it, which I definitely recommend reading it, it's you just go to carsongroup.com/outlook. You'll get there, right? Simple as that. And I think I got that right. I think the story, our story for this next few years is, the U.S. economy is going to do better than everybody else. and especially everybody else, a big part of that is China. China's economy is going to be slowing. I think that's going to be the story of the next decade, to be honest.
One more,
And then
actually.
portfolios, obviously the clear implication is overweight US. I know there's hindsight, not hindsight. I mean, there is hindsight bias, but there's home bias, right? There's home bias. But still, I think we've given some good reasons in our outlook why we like the US better than everybody else.
Well said. It's not official yet, but I think it's the old Jim Carrey. You're telling me there's a chance. Is there a chance the U.S. will grow faster than China last year? We don't have the data yet, right? It could happen, or how close will that be?
We'll find out in 2 days, but I think it's well, technically it's happened because we're talking about 2023. China's economy, in real terms, after adjusting for inflation, grew 5.2%, but inflation is flat to slightly negative, which means in nominal terms. So when you talk about the economy growing, like to at a cocktail party or something, we're talking about nominal GDP, right? I mean, nobody's really, is that adjusted for inflation? No, like how fast the economy grew 5%. That's what China's economy grew last year. Last year for the US, I think we'll be between 5.5% and 6%. So first time in decades, the US economy would have grown faster than China.
And I'll say this, if you're at a cocktail party and you're talking about returns, and someone does say to you, hey, is that adjusted for inflation? Let us know, because that's probably a peak. That is the peak when somebody's asking that at a cocktail party. So again, we're going to wrap things up here. Again, thank you for listening. Episode 69, Can You Take Me Higher? Brought to us by our friends at Y Charts. A lot of fun discussion on stocks at all-time high, economy still pretty darn strong in the United States, and we took a look at China's slowdown there. So Sonu, last thing, what's on your radar over the next week or so that investors should be following, and then we're done.
More new highs, hopefully, and then looking at small caps too. I mean, small stocks, mid cap stocks. I'm looking for some momentum there. I know you keep a closer eye on that stuff, but even in terms of portfolios, we are overweight those areas of the market, and I think there's some room to run there. Because they're nowhere close to all-time highs, right? And then obviously we're getting GDP growth. I mean, by the time the podcast is out, I think we'll get GDP data. It's a nice. It's a look back number. It's not telling you what's going to happen going forward, but the economy doesn't fall off a cliff, right? So it gives us some sense of how much momentum there's in the economy, and that's going to be, I think, a good number right there.
Well said. I looked at the timer. We went a little long this week, so we'll see how the downloads and listens go. We knew there's a lot to discuss. So if you've listened this whole time, we really do appreciate it. This is, again, episode 69. We'll be back next week with episode 70. Isn't that amazing? So with all that, everybody, enjoy your football. Stay warm. All-time highs are here. It's not such a bad deal out there. So we'll see everyone next week. Take care. Thank you. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.